Welcome back to the On the Money YouTube channel, powered by Allied Wealth. I'm Brian Wheelos, the founder of Allied Wealth and your host. And are you wondering what your tax expenses are going to be during retirement? Well, we're going to address that in today's video. But first, if you like the content we're putting out, please give us a like down below and also hit the subscribe button, and we'll keep updating you. We put out more content just like we're doing today. So this is one of the big questions that we have, folks, and I believe taxes in retirement will be a very, very big expense on your portfolio. And it's one we can't control because the people on the Hill can raise taxes, they can make our deductions go down, they can make our all kind of things happen to where tax deductions mean less and brackets go up. A lot of kabuki theater can go on, if you will, with taxes. And it's super important to have an idea of what kind of taxes you're going to pay in retirement. But first, let's think about it this way. Like most Americans, the majority of your money you will use to finance your lifestyle will be inside of a 401k, an IRA, or a pension, which most times you will take as a lump sum and roll over to an IRA, which makes it subject to the same tax laws as an IRA or 401k. And so the thing that you have to remember about these accounts is that every dollar you've put in these accounts over the years has gone in and you've gotten a tax deduction, which means you didn't pay tax on those dollars. The money that's been in the account growing in a 401k and IRA plan all these years has not been taxed. So what that means is every single dollar that comes out of your accounts when you retire and you start taking money out for income, every dollar is 100% taxable, and it's 100% taxable at ordinary income tax rates. So one of the things to consider is that when you get to age 73 now, going up to 74 and 75 here in future years, you are required to take your required minimum distributions out of your IRAs. And what that means is you're forced to take money out and pay taxes on it. Now, you don't have to spend the money. In fact, you can reinvest it, and a lot of people do, but the IRS says, hey, you're getting closer to the dawn of your sunset of your life, if you will, and we want you to pay some taxes on this IRA money you've had in this account all these years. And folks, quite frankly, we've all heard the old adage that there's two guarantees in life, death and taxes, and I really do believe RMDs is where that adage came from. So with RMDs, though, something to think about is if you're taking income out of your portfolio for retirement income purposes, and it's as much or less than your RMD, or excuse me, as much as your RMD or more than your RMD, that income you're taking out will satisfy that distribution requirement. So you're already kind of fulfilling that, which is pretty cool, all right? Now, one thing to think about, though, is that you should consider Roth IRA conversions, because what happens to these RMDs, these forced distributions, is they go up every single year and get larger and larger and larger and larger. I have clients that are in their 80s that complain every single year because their RMD is so much higher than their income need, and they don't like paying the taxes. So if you do a good Roth IRA conversion strategy, you may be able to offset some of those taxes you would pay on these RMDs in the future, all right? Now, it's a good idea about 5 years out from retirement, if you're really retirement account heavy, meaning the majority of your savings you're going to use to finance your lifestyle in retirement is in fact inside of a 401k, an IRA, or a lump sum pension. What you want to start doing is saving some money outside of those accounts and build up a war chest of after-tax dollars. That's important to do because you don't want to be in a situation in retirement when you need to go buy a new car and you don't want to finance it because rates are crazy through the roof like they are now. You want to pay cash for it. Well, if you pay cash for it, you're going to buy the car, you're going to pay the taxes on buying the car, plus you're going to pay taxes on the IRA distribution as well. So the car becomes very, very expensive in that case, all right? So if you have a bucket of funds outside of an IRA or a 401k or a lump sum pension, you can use those funds to pay for the car and not create additional tax liability on your car purchase. All right, so it's a good idea to start saving money outside of the 401k 5 years from retirement, building a war chest outside of your 401k, IRA, or lump sum pension. Now, one caveat to that. If you have a 401k match, make sure you're at least putting enough into the 401k to take full advantage of the company match. The reason why that is, folks, is if you put $100 in your 401k and your company matches you $100, that's an immediate 100% return on your money. You can't beat that return anywhere, all right? So make sure you don't give it the company match. Always take advantage of that, even though you may be saving money outside of your IRA accounts, all right? Let's look at a real-life tax scenario of a married couple age 60 who has income of $117,150 a year, all coming from an IRA. So the way you look at this is they have $117,150 coming out of their IRA, but they're married, all right, and they get a standard deduction of $27,700. So $27,700 is their standard deduction, and that comes off their income, all right, which means their total taxable income is $89,450. Now, some of their income, because of it's a bracketed tax system, is going to be taxed at 10%, and the amount of income taxed at 10% in that 10% bracket is going to create a tax liability of $2,200. And then some of that $89,000 in income is going to be taxed at 12%. All right, the amount of income taxed at 12% is going to create a tax liability of $8,094. All right, so when you add these numbers together, you get the total tax these folks are going to pay, which is $10,294 based on $117,000 of total income. Folks, if you think about it, that's not really a bad tax scenario. And these laws, these are current tax rates and current laws, which are subject to change. I hope they keep it this way, because if they do, you'll be able to enjoy a pretty substantial income and not pay a tremendous amount of tax in your golden years. Thanks so much for watching today's video. I hope you got a lot of value out of it. We'll see you next time.